I mean, one of the things that's fascinating about Japan is most experienced investors, so most people that you know, have some horror story about investing in Japan, right? And so when I started getting into it, what I realized was people don't like investing in Japan. There's a real institutional bias against it.
Herb, great to see you.
Thanks for having me.
Why don't you take me all the way back to your upbringing?
I grew up in a small town in Southwest Ohio, Beaver Creek, Ohio. My mother was a teacher. My father drove an oil truck. When I look back at that time, the most formative thing to me was the fact that my parents really believed that we should have jobs. We should be working when we were in school. So if you ever wanted to buy something, you had to make money for yourself. And so we were really encouraged to have jobs at a very young age. And so during that time, I started out as a paper boy when I was 11 years old. I remember the kid that had the paper route was like the only kid in the neighborhood who had money. And so when he ended up quitting, I really wanted that job. And so I was 11, you had to be 13. I begged my parents, I begged the paper company to let me do it because it was a route in the morning. I had to wake up at 4:30, had to deliver newspapers every day, 40 newspapers for an hour. But I was able to convince them to do that. And so, as an 11-year-old, you're running your own business. So you're taught responsibility. Whether it rains or snows or sleets or has a blizzard, you have to get up and deliver the newspapers. And then on the weekends, you have to collect for the newspapers. So, you buy the newspapers for 65 cents, you sell them for 90 cents. If people don't pay you, that's out of your pocket. I learned early on that I had a brother who's 5 years younger than me, who was super cute. And if I brought him along, we got better tips. I get candy, I get better tips. And so I used to always haul him along whenever I collected for my newspapers. But it teaches you responsibility. It teaches you have to show up. If people don't get the newspapers at 4:30 in the morning, they're not happy. And so I did that for 4 years. The thing I also remember at that time was, I used to think to myself, like when my friends are sleeping, I was out hustling. Some of the other jobs, so, I worked as a busboy. That was a pretty tough job. But I will say, you learn how to deal with all types of people. So if I'm at the golf course and I'm caddying and you have an angry CEO who's having a bad round, or you're in a restaurant and you have a customer who's really unhappy, you have to deal with those folks. And I also learned, one of the things I really remember was that I learned that there's a lot of really hardworking people in our economy and that get up every day and bust their butts and you can't support yourself. And when I was doing that, I remember thinking to myself, as someone who's in a small town, I want a lot more. I have to focus on my education. That's the only way that I'm going to achieve the goals that I really want to achieve.
As you went through school, what was the spark that turned you into finance and investing?
When I was younger, I would say, I had a lot of interest. I played a lot of sports. I worked a lot. But it wasn't really until later in high school and then when I got into college that I really, there was some spark that really just forced me to focus on my grades. I remember my mom was super proud of me. And that was a huge spark for me. Wow, I did something. My mom was so happy. She's been a huge influence in my life. And so that was a big spark. And then once you start doing well, you get good grades, that feels good. You get all types of opportunities. And so it really builds on itself.
What was your first job in the industry?
So 1990, I graduated. So I went to Miami of Ohio. As you remember, there's a pretty big recession back then. So I had a finance degree. I had an accounting degree. Always wanted to do investing. Didn't know a lot about it, but I was always intrigued by it. But at the time, Wall Street's firing people, laying people off. And so I didn't have the opportunity to go to Wall Street. My very first job was working at Peat Marwick as an auditor. And I remember from the first time I started working, and the one thing that I vividly remember at that first job is that, I've always felt like in life, I was running a race. And because of my background, because of where I grew up, I was starting this race way behind the starting point. And so for me, the only way to get ahead was to work my butt off. And so I've always had this mantra that nobody was going to outwork me. And so at my very first job, I worked as an auditor. My peers are working 40, 50 hours a week. I'm working 80 or 90 hours a week and got promoted very, very early as part of that. What I also remember is befriended somebody and I saw their career, they're 5 years ahead of me, and I saw what they were doing. And I said, I don't want to do that. And so I took a risk. I left Peat Marwick and actually went to go work for First Chicago, which was really my very first investing job.
What did you do in that first role?
I have to say, like, I've had a lot of really good fortune in my life, but one of the most fortunate things was I ended up, when I was at the bank, a position opened up in this group called distressed debt trading. And so what this group did, and this is back in the early 90s, and what this group did was when the bank had a loan that went bad, they would just sell it. And so this group used to do the selling of the loans. There was a woman who used to run the group named Jean Legrand, who actually was one of my very first mentors, who they figured out, like, we're selling these loans for 20, 30 cents on the dollar, and the buyers are recovering 70, 80, 90 cents on the dollar. Like, at the time, there was a very small universe of people who bought distressed loans. You had Sam Zell, you had some of the Drexel spinoffs, you had a group of Fidelity, but it was a very small, it was probably 10 people that we were trading these loans with. But the bank figured out, wow, instead of selling these, we actually should be buying these loans. And so they were one of the very kind of pioneers in distressed debt investing that figured out they had old workout people that were in the group. So they had the bankruptcy expertise. They had capital from inside the bank. And so we were instead of often buying these loans from them when they were going bad, we actually were going out learning about what the recoveries are going to be. And then we started buying loans from other banks, and we actually built a pretty good business during the early 90s doing that. And so, at the time, I didn't know that was going to be a big chunk of my career. I didn't know that was going to be an exploding asset class. I didn't know it was going to be nearly as profitable as what it was. Back then we used to evaluate every company at 4 times cash flow, every company, and you'd buy them at 2 times cash flow, right? And you would make gobs and gobs of money for many, many years. One of the things I learned from that job was that, I've always believed in finding mentors and also mentoring people. And so I've been the benefit of phenomenal mentors throughout my career. I mentioned Jean Legrand, one of my very first mentors. But throughout the years, I always would go to people that I respected, and I say, hey, do you mind if we grab coffee or grab lunch once every couple of months? I really respect you, and I find you to be very insightful, and I'd love to pick your brain on issues. And so over time, by doing that, I just got to meet a lot of great people, but also got phenomenal guidance for my career. And then over time, I ended up mentoring people. And actually, I think being a mentor, you actually learn more than being a mentee. So often young people will say to me when I meet young folks, they'll say, what advice will you give to us? And I always tell people, I always have 3 pieces of advice. One of them is like, find a mentor, just ask somebody. Most people will say yes. If somebody says no to you, they're never going to be a good mentor anyway. So that's fine. I also tell people, like, don't worry about how much money you make when you're in your 20s. It doesn't matter. Just take a job where you can learn, you can grow, you'll get good at it, the money will follow. But I find there's just way too much focus on people trying to maximize their income at a point in their career that it really doesn't matter. And the third thing I say, which I was a huge beneficiary of, was get into an industry that's growing, a business, an industry, or something that's growing. Because if you are, you could, like, I think about distressed debt investing when I was in the early 90s. But if you're in an industry that's growing like a weed, you get so much more responsibility faster. You learn. You become a pioneer with very little amount of experience. And so if you can do that, just like tons of great things fall from it. So I was an early investor in distressed debt. I was early when I went to Appaloosa when I was young as well. And that was one of the kind of first larger hedge funds that existed. And that whole industry ended up exploding. So I've been the beneficiary of like these massive tailwinds behind me. And so that's another thing I always encourage folks to do.
When you were in that first role, you had a great mentor, you were in a growing space that was doing really well. What led you to leave?
I loved the job. First, Chicago offered where you could actually get your MBA at night and they would help finance that. And Chicago is a great city where you actually use both University of Chicago and Northwestern have night programs. And so I was working during the day. I was getting my MBA at night. Actually, funny enough, I met my wife during my MBA, and we've just passed our 29th year anniversary. So it's fantastic. So you meet great people, but I was working a lot. And I think for me, like I looked at the bank and thought like there was a cap to what I could do there. And there was a lot of smart people that were in front of me. The group was highly successful. But I wanted to learn. I wanted to learn, okay, not only what they were doing, I wanted to think about different asset classes, think about different parts of the public markets. I wanted to grow, I wanted to be a great investor. I was there for 4 years, I think. And I feel like I learned a lot, but I just had a thirst to learn more.
And where did that take you?
So when I graduated with my MBA, moved to Boston, And so I ended up like so I ended up first went to Putnam. And then I was there for a short period of time, and then I got a call from Dave Tepper to go work at Appaloosa. So another incredibly fortunate thing, Ted, for me is I've worked for two of the best investors of my generation, right? Dave Tepper and Seth Klarman. I mean, it's incredibly fortunate. Like I did research on both of them before I went to go work for them, but I had no idea how talented either one of them was and how successful and how much I learned from them as well. So I went to Appaloosa and went to go work for Dave. And I mean, one of the things I learned from Dave, like Dave is one of the most, he's an incredibly talented investor, but he has a nose for opportunity that I've never seen before. Like he is like a moth to flames in terms of trouble, risk changing, pricing changing. I mean, he can look at any asset class, can really understand the fundamentals. You know, I was there when we had the Asian financial crisis. We found great opportunities there. I was there during the Russian default back in 1998. But Dave had this ability to traverse multiple markets, think incredibly sharply and simply about macro risk. And when there was massive dislocations amongst fundamentals and prices, he would really jump in, price assets, learn how investors were thinking about them, and be very aggressive at the right time. And when there wasn't great things to do, he would do nothing. And so, you know, when I think about the variety of things that we did there and the variety of areas that he's been successful in over time, it's very, very unusual. So I felt like I learned a lot. I felt incredibly fortunate to have worked with Dave and to have learned from him and to watch him invest.
When you think about the Appaloosa style, the Baupost style, almost opposite ends of the spectrum in terms of risk-taking, what did you see, say, first at Appaloosa and seizing that opportunity when it's there?
Appaloosa has more volatility than what Baupost does. So Baupost has a very robust hedging program, just a much different culture of the organization, more diversified in terms of what they owned. And so Dave tended to be he was a lot more concentrated, a lot more aggressive. And he didn't mind wearing volatility. I think that was something that he was very comfortable with. And, you know, at Baupost, it was also a value strategy, less trading oriented, more just really fundamental based. There was some private assets that they were doing as well. But you're right, they're two incredibly talented people with really different investment philosophies that have both been just incredibly successful.
How did you go from one to the other?
I got a call from somebody who knew Seth, who said Seth was looking to add to the team. And I remember my wife and I went and had dinner with Seth down when I was in New York, and we just really hit it off. Like Seth is a incredibly kind, thoughtful, and crazy smart, phenomenal investor. Like he was willing to mentor me. He was willing to invest in me. I felt like he loved investing and he wanted to do it for many, many more years. And there was phenomenal people there that I got to meet as well. So, sometimes you just meet people, things just click. And when I met Seth and spent time with him, I was like, wow, I can really learn a lot from this guy. And I can hopefully learn how to become a good investor from him. And then we were off to the races.
What was different from what you might have anticipated in that style of investing when you got to Baupost?
The first thing that jumped out to me was you'd walk in during the day and it was quiet. And everybody had their heads down. Everyone was reading, doing research. And I remember thinking to myself, like, wow, this is a research organization. Like they're investors, but they're really researching incredibly deeply what they're doing. As you start to understand the Baupost philosophy, like they're really trying to understand situations that they're in better than anyone. They bring in outside resources. They're incredibly smart people. They're very long-term oriented. Like I always say to people, like everyone thinks they're a long-term investor. I think less than 5% of people are truly long-term investors, and based on my experience. But they were truly long-term. And so, the model there was really hire great people. Seth would mentor you, give you resources, help you invest. Invest alongside of you. And then as you did better, you'd get more responsibility and you'd hopefully grow and have a bigger impact. And so that was very refreshing to me. It was a culture of intellectual honesty, of trying to get to the right answer. But fundamentally, I thought about it as a research-oriented firm.
If you take call it high-level investment philosophies of the two firms, How did you think about what was resonating most for you into different cultures, different environments, different styles?
Yeah. So the thing that's unique about Dave Tepper is I don't know many people who have been as successful as he has in multiple asset classes, right? I mean, he started as a high yield bond trader. He did a lot of distressed debt, did a lot of credit, but then he did a lot of emerging markets, did a lot of sovereigns. And now when I listen to Dave talk, I think about him as being a macro investor. I mean, he has incredible insights on, almost any market, rates, currencies, et cetera. And he's been successful like in all these different areas. It's very, very unique, very unique. Seth has also been successful across a lot of different asset classes. I think for me, what it was is I looked at myself more like Seth and Dave. Like Dave has a very unique talent, but when I was at Appaloosa, a lot of it was feeding information to Dave making decisions. I wasn't sure I could ever be like Dave. Working at Baupost, because the Seth mentors folks, I just thought that I could develop and grow a lot more under that structure. And, the research orientation, the long-term orientation, it just struck me as something that I could be more successful. It just fit more with my personality.
How did that play out over your years at Baupost?
I started as an analyst. I ended up growing, kind of rising through the ranks over the years. And the model of how Baupost invest, I think, is actually very similar in a lot of ways to how Finepoint invest. And so, I was at Appaloosa for a couple of years. I was at Baupost for 14 years. Clearly, the DNA of Baupost is going to rub off me a lot more just because of that. It was a better fit for who I thought I was as an investor and how I like to invest and how I thought I was going to be successful.
I'd love to ask you about two aspects of the evolution over your career into Finepoint. Generally speaking, value investing and credit markets, where you kind of started. Value investing's had a tough slog over this last 10 plus years. How do you think about what it means to be a value investor and how you try to go about it?
When I think about value investing, to me, what I think about is really trying to find misunderstood, mispriced assets in a whole variety of markets. And, it used to be back when I was just getting started, it was buying cigar butts, like Warren Buffett and Benjamin Grant used to talk about. So for me, really what it's about was more about identifying areas where there was structural mispricings, going up and actually doing fundamental work and valuing what securities or assets are worth in these areas. And then when you can value them and you can buy them at a big discount to that, and there's a catalyst to help you realize value, you do it. And when there isn't, then you don't have to invest. And so when I think about the different areas of what I've done over the years, of what I've worked on, it's pretty broad. It's like take, for example, we did a lot of stuff with, started out doing credit, high yield, distress, and then we ended up, moved into structured products, did a lot of stuff in South Korea for a number of years, Japan. Then we ended up moving into reinsurance and different credit derivatives. So it's a pretty broad mix of products, but I think the common denominator is it's out of favor, it's hated. There's something, you can have a view that's different than the market. You can understand why it's cheap, and you can have a view for what it's worth. And sometimes when you can buy things at a discount to that and there's a catalyst, and you go ahead and do it. When I think about traditional value investing, to me, that's buying cheap stocks. So cheap on book to, price to book, cheap on enterprise value EBITDA. What's interesting is when I was years ago, we did that. We did a lot of that. And that would result in good investment returns. I'd say probably about 10 or 12 years ago, that stopped happening. Like what I found was we were buying situations where we had a differentiated view that were trading at a big discount to what we thought they were worth based on the metrics we had always used historically. But what was happening was our underwriting was correct, stocks would go down. And so that was happening over and over again. Underwriting correct, stocks go down. And so we ended up pivoting a number of years ago. Like we don't want to be dependent upon what the market tells us something is worth. And that's why a lot of what we do is catalyzed. So that was one of the big, I would say huge change that I made in my investing style, probably starting about 10 years ago, was not buying things just because they're cheap, but really looking for catalyst. And what's fascinating to me as well is, the other thing that I think one of the reasons that value investors have underperformed, I think in the last 10 years, is that there's a lot of technological disruption that's taking place, and it takes place faster than it used to. And so, if I look at when we underwrite a mediocre business and we project out cash flows, if I go back and look at those, which we often do, the decline is always often faster than what you think it's going to be. And so I think that's the curse of the value investor is, buying mediocre businesses at cheap prices. That has not been a good strategy. And so luckily we realized that years ago, and we really pivoted away from that as part of our strategy.
Are there any other significant changes from your thinking about value investing over the years?
The other big one is how I value the leader of an organization, and mostly a CEO. So I would say the value that I give to leadership is significantly more today than what it ever was in the past. And this actually applies to CEOs, but it also applies to leaders in the government, or if I'm trying to do something with a not-for-profit, how a leader can influence an organization and what type of impact they can have. The way that I weight that in an investment or when I'm thinking about partnering with somebody is significantly more than what it ever was in the past. And I think that's just through a lot of bumps and bruises and over the years and a lot of investments. When you invest with great leaders, good things, you're always surprised on the upside. When you invest with mediocre leaders, it seems like you're always surprised on the downside. And so that was a big change as well.
How do you assess the difference between the mediocre leader and the great leader?
I think it's through a lot of experience and is spending time with a lot of different types of people. So the way that we have found is best is by finding people who have worked with them who have a positive or even a negative impression of them. And if we get a lot of that data, the other thing I often will do is, often I've been doing this long enough where if I'm looking to invest in a company, I probably will have a friend who I've known for a while who also knows the individual that we're looking to invest in. And so, being able to call people who I trust and really ask them how, kind of how they think about a specific leader, that has been helpful as well. But I also think the third thing too is I think that, it's what people do, not what they say. And so it's really rolling up your sleeves and looking at their history, looking at what they had done, looking at their data. So often what I do today, I'm probably more reliant on the numbers and like what people are doing, the actual facts, or that's what's in front of you, less so than just sitting down with somebody and having coffee and walking away and saying, boy, that guy is trustworthy.
And the other credit markets, right? You started buying loans at 2 times cash flow and selling them at 4. The world's changed a lot since then. How do you think about the credit markets today and how that's changed?
So I have been a credit investor most of my career. I've invested in a lot of different pockets of the credit markets. It's clearly a lot harder today to invest in credit than what it was when I was first working at First Chicago. So we do keep a very close eye on the credit markets. I do think, even though we're sitting here in the summer of 2025, our credit exposure is at historic low levels. Spreads are tight. There's a lot of capital. And when I look at where new issue is getting done, how there's no covenants, now in credit, you have these LME fights that are going on, these knife fights between creditors that's really eroding value or can erode value or could be an opportunity. So there's a lot of changing dynamics that are happening in credit right now. However, I do believe credits have been historically pretty volatile. And I think it's for reasons because you tend to have money coming in and out of those markets, especially during times of stress. I am very excited about the credit opportunity set for the next 3 to 5 years. We don't see it right now, but if I think about the dynamics of the credit markets, there's a couple of things that jump out to me that say to me, this could be a really great place to invest. So number one, the number of assets in the credit markets that are held by vehicles that offer daily liquidity is growing dramatically. So mutual funds, ETF, passive vehicles. So the percentage of those funds, those percentage of the market's assets that are held by those vehicles continues to grow. Number two, the credit markets there's not a lot of liquidity in credit markets. And so when retail investors or people decide to pull money out, because the dealer community in credit has, capital's down by 90+% over the last 15 years or so, the price movements that you see in credit tend to be very, very severe. When there's a shock to the system, it used to be you had weeks or maybe a month to buy something, but now you have days because the volatility is so great because of the fact that you have money coming out, forced selling. Dealers don't really have the capital to absorb it. And so you tend to get a lot of volatility in credit. The third thing is I'd say a lot of our competitors have moved to doing private credit. When I look at what's going on in that market right now, it strikes me as pretty competitive and not really a great place to find attractive risk-adjusted returns. And it's never been through a credit cycle, as you know, so we don't really know how private credit is going to perform when things don't go well, which will inevitably happen. We'll have a recession at some point. And so, but we've had a lot of our competitors who on the public side just aren't doing that anymore. And then the last thing I'd say is the markets are enormous. The credit markets continue to get bigger and bigger. At some point, you'll have an SVB happen, which happened in 2023 when you had the run of the bank, right? And that thing kind of came together, and that whole thing collapsed in over maybe a couple of days or a week. So you had Credit Suisse that had a very quick demise. And so I do think, there'll be a lot of things that will happen episodically that will lead to opportunities. The telecom space was a mess last year. We found things to do in telecom. But business fundamentals will change. We will see volatility. There'll be a horrible hurricane that hits, Puerto Rico or some area that will cause bond prices to change a lot. There'll be a big financial fraud. Like I joke around, like we haven't seen a good financial fraud in a long time, right? But I've seen a lot of those in my career, and I think we'll see those going forward as well. And so that will lead to good opportunities. If I go back to my example of 10 people used to do distressed investing back in the early 90s, now I don't know the exact number, 500 to 1,000. It's some huge number. And they're all smart. And by the way, in the early days, we used to be the only ones that would hire bankruptcy lawyers, financial advisors. So we had this real edge. And that actually lasted for probably up until the last 10 years ago. Now everybody hires the best bankruptcy lawyers. Everybody hires the best financial advisors. So it's just hard to get your edge. And then if I think about the other stuff that we're doing, and it's the opposite end of the spectrum. It's differentiated. It's not competitive. And so those are the things that we always gravitate to.
So as we dive into that and what you're doing, when you bring to bear both the experiences you've had and then these perspectives about how value investing, credit markets, and other things have evolved, how did you lay out what it is you're trying to do at Finepoint?
We're really trying, ultimately we're trying to compound capital over a long period of time.
Sounds good.
The way we do that is we have an open mandate. So our clients have given us a lot of trust that we can look across a lot of different global markets, and we can look for areas of structural mispricings. We go in, we underwrite assets, and we can buy things cheap with a catalyst. We'll do it. And we can't, we'll move on. I feel like our job is to find really attractive risk-adjusted returns, and we have a global mandate to do that. So, and I'm also a big believer, we don't have to know everything. Often people will say, oh, what do you think about the European stock market? I don't really know a lot about it. I don't follow it that closely. And so I don't really have a view. We have this saying here that, investing, you don't get paid for difficulty points, right? It's not like diving, where the tougher the dive, the higher your score. For us, that doesn't exist in markets. And so for us, one of the things we try to do and I try to do is really have a sense for, okay, what can we know? Where are assets priced? Where is there a lot of stress? Where are there problems? As a big event happened that's maybe caused people to run away from a market. And then, can you really understand, is that a risk that you can really understand? It's important to know what you know, but it's more important to know what you don't know. And I'm a huge believer in that. That's really stuck with us. We look at a lot of odd things. And you have to ask yourself, can you really understand the key risk? So often you think you can, but you can't. And so that's something that we spend a lot of time on. So we look at it when we're looking at a different market or an opportunity, that's the key question that we're always asking ourselves.
So when you have a global opportunistic mandate and there's a lot of things you don't know, how do you figure out, first what you're trying to canvas to then learn enough to know when you want to dive deep?
So for us, so it starts with really just generally having an understanding for what's happening in the world and some of the key markets that we see potential opportunity. So we're looking for areas that have been volatile, things that we can understand, that we can underwrite. One of the areas that we have gravitated away from over the years is take emerging markets, for example. So, the sovereign risk, the macro risk often are the most important risk in any asset you're looking at in a specific emerging market. So we don't think we're good at that. We haven't had a lot of great, we just haven't had a lot of great reps. Years ago, I would say I was better at that, but I think the uncertainties have grown over the years. And so also take, for example, when the Chinese property developers all blew up, when Evergrande blew up back in 2023, we spent a lot of time trying to figure out, could we understand the risk? We ultimately decided we couldn't, because so much of it was dependent upon the government. And also so much is dependent upon the accounting and how the banks treat these different developers. And it was very hard to get really good insights on that. So, but more importantly, so there's a number of markets that we keep a really close eye on. Every component of the credit markets, we are laser focused on. If I think about Japan, like Japan was something I had looked at every year for a long time. But because of these changes that started to take place in 2014 and 2015, then we actually started investing. So, I was an investor in South Korea for a very long time, and that was something that we know well. So there's a number of markets that we have exhibited a lot of the characteristics that we look for, that we have a lot of relationships in, that we talk to folks on a pretty regular basis. So we're keeping a close eye on. So when something happens, when you have an event, like for example, 2016 when oil prices collapsed, like there were certain components of the credit markets that got really attractive during that time. And so, we knew the companies, we've invested in that area, so we were able to take advantage of that. If you have a geopolitical event, for example, like, for example, when you had, when Greece essentially defaulted and they almost defaulted a second time, like, you have these big events that happen and you run to them and you say to yourself, can we underwrite this risk? And is this risk attractively priced? So it's funny. What I found over the years from the outside, I think it seems overwhelming because there's so much to look at. But when you're in the inside and you're like making the sausage and you're sitting around a table with your colleagues and you're going through what's happening in the world and how assets are being priced in a specific market, and is there a catalyst and can we have conviction? It actually becomes very clear.
I'd love to dive into the example of Japan. So you said you looked at it every year, but then about a decade ago, you decided to start investing. What was the reason that you first said, okay, now's the time to get involved?
As a value investor, I've had numerous friends and folks who've gotten excited about different Japanese opportunities once, twice, 3 times a year. Before Finepoint, I really never had invested in Japan. So, we roll up our sleeves, we do work on these companies. We generally always found the same problem: great company, cheap price, poor governance. They were accumulating a lot of money and the money was set in the balance sheet. They weren't reinvesting it. And so they weren't creating value. And also disclosure was difficult. The accounting was difficult. And so it fell into the category of unknowable. So we ended up not investing. So the big change that happened was, 2012, when Shinzo Abe came into his second term as prime minister, he started to recognize that when you have these great companies that are generating fat profits and all this money just sits on the balance sheet of these companies, they don't do anything with it. It's actually destructive for the economy. And so he was really kind of ahead of his time. So in 2014, he came up with a corporate stewardship code. In 2015, the corporate governance code. So the corporate stewardship code was a kind of a roadmap for asset managers to hold companies accountable for better governance. The corporate stewardship code was telling the companies what they should be doing. It wasn't mandated. It was more, here's some frameworks for what we think you should be doing. So we saw that and we said, that seems really smart. This is a market that seems ripe for that type of movement or that type of action. Let's see what happens. And so, in the subsequent years, we kind of started keeping a close eye. Who was adopting it? Who wasn't? We started to see dividends increasing. We started to see share buybacks, selling of some cross share holdings, at a very minor level. And so over time, we really rolled up our sleeves and said, is this time different? Like, are these changes really going to stick? And do investors care about them? So, one of the things that's fascinating about Japan is most experienced investors, so most people that have some horror story about investing in Japan, right? And so when I started getting into it, what I realized was people don't like investing in Japan. There's a real institutional bias against it. You had a big asset bubble that exploded in 1990. And this has caused a lot of pain. And there's a lot of people who just have a bias against it. So second thing I learned was, people would say to me, oh, there's so much sovereign debt in Japan. Yeah, and there is. There's, debt to GDP for Japan is 250%. But the central bank ends up owning a large chunk of that debt. So the actual net number is a lot smaller. Japanese interest rates are lower. But what's fascinating about Japan, and I think what people miss, is that when you're looking at the leverage in an economy, you have to look at every level. So the Japan sovereign leverage is high, but net of the central bank is actually manageable. The banking system is well capitalized now. Corporates in Japan, and then households, they're all net cash. And so households sit on massive cash balances. They generally don't like to invest in the stock market. So if you look at the economy collectively, it's actually not that levered. You compare that to the US, for example. The US has, our sovereign debt now is getting close to 100%. Our banking system is well capitalized, so we're similar there. But our companies have a lot more debt, and individuals are very levered. And so for some reason, there's a bias against Japan because of this one number, which we just didn't think was told the whole picture. So
when you go to dive deep on Japanese companies sitting in Boston, you have cultural differences, you have language differences. How do you get up the curve to the level of depth that you would want to take significant position?
So you are exactly right. The barriers to invest in Japan are enormous. So the cultural barriers are huge. The language barriers are huge. The accounting is different. The time zone is different. I mean, I can't tell you how many times I wake up at midnight or 1 o'clock for a telephone call. So it's tough. It's difficult. And so when we probably spent over a year underwriting Japanese companies, spending time over there, understanding all of this. Before we made our first investment. So, if you fast forward to today, we have 5 people on our Japan team that speak Japanese. And so we understand the accounting, we understand the cultural differences between the two. I was always amazed when I first started going to Japan. We'd have investment meetings, and we have the Japan team, and we go in, and I'd come out and I'd say, wow, what the guy just told me was A. And the Japanese guys were like, no. He wasn't saying A, he was saying B, C, and D. And I was like, what? And so what you realize is they communicate in a totally different way. Relationships are very important in Japan. The government is very important in Japan. You need to be on the right side of the government on every investment that you make. That's very important. The government, I tell people, is the biggest activist investor in Japan. Like the other barrier I always hear about people in Japan investing in Japan is they'll tell me, oh, the demographics are a disaster, right? I mean, the birth rate is low. Everyone knows that. The death rate is high. There's very little immigration. The population is shrinking. All true. What the government's figured out is because of these demographic challenges, they need to attract foreign capital. And so they have been doing a lot to try to make it easier. And so what's interesting about Japan is you have this tailwind of governance reform that's actually being led by the government and being adopted by a lot of folks. And so to answer your question, when we go over there and we actually, how do you underwrite a Japanese company? We're not trying to invest in the market. We're trying to find people and most CEOs, boards who really understand the benefits of better governance. So we're not activists. We don't push people to do anything. For us, if we buy stock and we meet with them and then we don't like what we hear, then we just sell the stock and move on. So what we found in the early days is there was companies that were starting to adopt these changes. And when they started to adopt these better governance changes, the opportunity is massive. So think about a company for 50, 60, 70 years that always paid low dividends, always held on to their earnings, had massive cross shareholdings, owns all their real estate, has no leverage at all. And so if you start to get them to say, okay, let's think about your cost of capital. The way to reduce your cost of capital is to take a little bit of leverage out at 1% or less, recapitalize your company, maybe buy back some stock, or maybe reinvest or buy or reinvest in a growth business. The heart of the opportunity for us is there's very few people like us over there. So Japan is still, most global long-only managers, most asset managers are underweight Japan still. I believe I'd never been able to kind of exactly quantify this number. I think almost or over 90% of the market is passively managed. So there's very, very few fundamental bottoms-up investors in Japan. So when we go in, we roll up our sleeves and we engage with these companies, other people aren't doing that. And we can really have a differentiated view. With every investment that we make, we spend a lot of time with these companies. It could be years before we actually make our first investment. And so, we're not going to invest just by what they say to us. We need to see them start to do things. And what's fascinating about Japan, because these opportunities are so big, you could see them do things for years and the stock prices don't react at all, where we can actually gain conviction on what they're doing. And as we started making these investments, what we figured out was the companies that were making these changes, the stock market was recognizing the increase in value, but generally not until the 7th or 8th or 9th inning. Like once they started seeing the benefits of a lower cost of capital, higher margins, selling off, bad businesses, reinvesting those businesses into growth businesses. Once you started seeing that in the numbers, that's when the Japanese market started to get excited. So we kind of saw that and really started engaging and figuring out where are these changes, like who's serious about these changes. And luckily we've been doing it for 9 years now, because we need to see a lot of tangible change. We need to spend time with people to really understand, do they believe this? Like if you look at 20 years ago, there was a big push for activism in Japan that largely failed. Today, the market is ready for it. So if you look at it today, these reforms are accelerating. The government continues to push hard. Companies that make these changes, stock prices go up, and everybody wins. And so we feel like we're part of this revolution that's taking place. We're helping steward companies. We're helping them realize a lot of these positive benefits. And so that's the core of our investment effort.
Within that broad group of companies making significant governance changes, have you found any either sort of sub-strategies or sectors where that has been more prevalent than others?
The answer is yes. And so what's interesting about Japan is typically when you see a company in an industry start to make significant changes and their stock prices go up and they start to reap the benefits because now they have excess assets to buy grow other businesses, what happens is you start to see other people follow in that same industry. IT services, for example, where there's been a few companies, like Hitachi was really one of the leading companies in this area. So they started making a lot of these changes and really started to, sell off listed subsidiaries, sell off excess assets, reinvest in growth businesses. I mean, the stock price has done tremendous. And then other companies like to follow as well. And there's some industries that are I'd say that are very slow to change, and they really haven't adopted the benefits of better governance. I would say, I don't exactly know what percent of companies are actually taking positive action, but it's less than a majority. I think eventually most companies will do it, but this is still, we're still in the infancy. I'd say the last few years you've seen a lot more of an impact than the 5 years before that. So I think that's really positive. But there definitely are industries who, because there's a leader, because there's someone who champions the cause, that a lot of other people see the benefits and then they follow.
So you mentioned that you don't participate as an activist investor, but the time may be ripe for activism. How have you looked at the behavior of activists and companies in your investment remit?
We would rather find great companies and great management teams. I'd say today what we have found is, 20 years ago, I don't think people understood what the activists were doing and why and what the benefits were. Now, I think the market really understands, okay, there's an activist who's going after, who bought stock in a company that has massive cross shareholding, huge cash balances, owns all their real estate, very bad margins. And so investors say, wow, that's an opportunity. And so if there's an activist that gets involved, what you see today is there's a lot more support. They say, oh, everyone is doing this. This is really good for the market. It's good for society. And so there's buy-in amongst the asset management community. There's buy-in amongst the government. And so when you start to see activism take positions and advocate for change, kind of everyone piles in behind them. So now there are instances where you still have companies that fight them really hard. But just the kind of the culture around activism it's really changed. And it's and I think it's because people see the benefits of it. I think that, and so I think that's the biggest reason.
When you started investing in Japan a decade ago and have continued since, you built up your team, how have you grown your exposure in thinking about the risk reward to where you are today?
So when we first started doing it back in 2017, it was a new market for us. There was a lot of changes that were taking place. We weren't certain. Our relationships were newer. So it was a smaller part of what we did. As we did it more and started having more success, and the things that we were underwriting were actually happening, stock prices were trading to what we thought they should, events were happening that we thought were likely to happen. So as we had more and more success, we also, we built out a great team who manages the effort. So as we got more confidence in the team and what they were doing and how they were engaging, the exposure continued to grow. And then if you fast forward today, it's a very large exposure for us. People ask me all the time, like, how much longer will it last? And I really feel like, Japan, I think, is the third largest equity market in the world. Minority of companies have actually gone through these changes. I think I don't know if you're in the third inning, the fourth inning, the fifth inning. The number of people invested in Japan really hasn't changed that much. So what's fascinating to me too is, we've had success, others have had success. Asset management is competitive. Like, you think when you see firms that have outsized returns, you'd have a flood of folks running to run into a place. But it goes back to the barriers to entry. The barriers to entry are high. I remember the early days when we were investing in Japan, you have to, when you go to see a Japanese company, you have to go through a process. You have to go through the junior IR person, then the senior IR person, then like the controller, then the head of accounting, and then like the head of accounts payable. And like maybe you'll get to, the treasurer, and the holy grail of the CFO is like maybe 6 years, 5 years later, you get to the CFO, and the CEO would never meet with anybody. We don't always go straight to the top, but often we do. But we have a reputation that we've developed over there where people trust us as stewards. They trust us as investors. They know that we're doing things for the right reasons. We're long-term oriented. And so that's really a big difference today than what it used to be. So, but I'm very excited about our effort there. I'm really excited about the changes that are taking place as well.
What are some of the other opportunities that excite you?
So I'd say there's two other things. I continue to be really excited about the credit opportunity set for the next 3 to 5 years for the reasons that we discussed. Even though we have a much smaller exposure today, that's an area that we're excited about. And then the other thing we're doing right now is we have some exposure in the reinsurance. Reinsurance is an area that we looked at for a long time, never invested. The event that really repriced the market was Hurricane Ian when that hit in the fall, I think, of 2022. That was a very devastating hurricane to hit Western Florida. It caused almost $50 billion of insured losses, significant loss of life. When that event happened, you had a run up of a few years before that with bad hurricanes. You've had really high construction cost inflation. You've had higher interest rates. And so what we found was, when we got into is, insurance companies in Florida had pretty big holes in their balance sheets, and they were writing risk, and they were being forced to offload that risk from rating agencies or regulators. We followed the market for a long time. We saw this event. We saw how risk was starting to get priced in 2023. And it was significantly different than any time in the past. And so, and the way I characterize it is, if you underwrite a risk that has a 1 in 10 chance of happening, historically that would get priced that you get paid 15 or 20% to take that risk. So that number is over 50%. So the pricing around a unit of risk in Florida wind now is significantly different than it's ever been in the past. And so for us, we spent a lot of time underwriting the risk, the market, and we built a decent sized exposure to that. And then, we actually have 4 verticals that we operate within the reinsurance space. But the other thing that has really been significant that's repriced risk is the California wildfires from last year. Those are very devastating, once again, significant loss of life. But you've had a lot of insurance companies pull out of California. And these insurance companies need capital to underwrite risk. And so the way risk is priced in that market has also changed pretty dramatically. And so I would say, reinsurance, because of a lot of the losses that have taken place, and because of the insurance companies, kind of having a lower amounts of capital, that's another area that we see great opportunities right now.
What risks in Japan are you worried about?
So, the one thing we should at least talk about is, there's a lot of risk in our portfolio that we have no control over. So, there's significant geopolitical risk in Japan. Every market, they think about China, Taiwan, there's a lot of geopolitical risk. We could have another global pandemic. We could have a recession. We could have high inflation and interest rates. And so we actually have a pretty robust hedging strategy we hedge, since we're fundamental investors, we hedge currency, commodity, and interest rates at the investment level. So for example, we hedge the yen. We don't have a view on the yen dollar. We think about ourselves as being dollar investors. So we hedge anything that's not dollar back to the dollar. So that's something we do. Same with rates. We don't have a view on rates, so we hedge that out whenever we buy fixed income instruments. And then on top of it, we say we own a basket of financial assets. We have no view on the risk of those events, those types of events happening, such as a recession. But often the way the markets are pricing, you can buy protection against those risks in a variety of different forms for very cheap, at very cheap levels. And so we build a basket of financial hedges on top of our portfolio when vol is low. And then when vol is really high, we typically sell them. And so we have a dynamic hedging program that we employ. I worry a lot about China, Taiwan. I worry about a lot about an earthquake. Like you can have another, Japan has a history of horrible earthquakes, obviously, which led to a nuclear disaster. I think Japan has, the demographic changes that we talked about. So, one of the ways we deal with the demographic changes is, as I mentioned, the government's incentive is really trying to get foreign investors to come in. Most of the companies that we invest in actually most of their business is outside of Japan. So that's one of the ways that we deal with that. But I do believe these hedges that we buy protect a lot of our downside in these scenarios. So because it's dynamic, we tend to really load up on the hedges when they're cheap, and then we sell them. So we ended up selling a big chunk of our hedges, for example, around Liberation Day when that happened.
The one hedge or the one risk that you didn't talk about hedging that would be really hard in reinsurance is if the pricing is justified by climate change. You can see the price. It's much harder to see the risk.
Yeah. So the thing that's fascinating about reinsurance is that a unit of risk, say there was a vanilla measure for a specific risk. There isn't, but let's say there is. The way that it's priced across different structures, vehicles, and different markets is dramatically different. So actually, one of the hardest parts about reinsurance is just sourcing the risk. It's an opaque market. It's a lot of bilateral contracts. To answer your question about climate change, we are very worried about climate change. We spend a lot of time thinking about how do you price it? What does it mean? We spend a lot of time with scientists really trying to develop a view on that. I say where I come out is, take that 1 in 10 year risk that we talked about. So I don't know if it's 1 in 10 years. I don't know if it's 1 in 9 years, 1 in 8 years, 1 in 7 years, even 1 in 6 years. I'm not sure, but I know it's not 1 in 5 years or 1 in 3 years. And that's how it's being priced. Often what we see is it's priced so dramatically that that's the opportunity. So one of the things we've heard from talking to climate scientists is that the world's getting warmer without a doubt. Sea surface water temperatures are rising. A lot of it, there's some has to do with the ENSO cycle as well. But the risk is increasing without a doubt around large hurricanes. And we've seen that. So, but what they'll tell you is that it increases very slowly. So year to year, you don't have big changes in the risk of a large hurricane. Over 10 years, 20 years you do, which is kind of what we've seen. But it's a slow moving increase in risk. And that's what's fascinating to us, is because you can have these year to year changes in the pricing that is really, really dramatic, right? So, the thing that I talked to you about, that 1 in 10 year risk might go to over 50%. Next year, it could be 30% or 20%. And so one of the benefits of our model is that we won't invest. We'll move on and we'll be doing something else. If I look at credit, for example, there's great times to be investing in credit. There's not great times. When I think about structured products and I think about the subprime trade back in the mid 2000s, you got into that market. Most people who were buying risk and who owned bonds, they knew it was insane. They knew it was being propped up by this easy financing that was taking place. And so you talk to them but they said, we have to invest. Like there's so many of my peers who are doing something very specific to what their mandate says, and they have to invest. And so for us, we don't have to do that. So when credit's not interesting, we're not going to do it. When reinsurance isn't interesting, we're not going to do it. If Japan changes, we're not going to be doing Japan. I think it's one of the biggest benefits to what we do. Like the financial markets are so large, and I've done so many things over the years. Like a lot of it I could never predict. Like if you would have said to me, hey, Herb, when you started Finepoint, what's the chance that you're going to have, over a majority of your assets in Japan? I would have said you're crazy. And here we are. That's where we are. Or if you would have said, you'll be doing stuff in the reinsurance space, I would have said, what is that? And so And that's the great part about our model. So, and behind those areas, we have a number of other things that we're working on that we're in the process of, seeing if they meet our bar or not. So, I do feel very fortunate that our investors allow us to invest in different markets, to operate with an open mandate. I think they look to us to be the person who decides how much equity exposure do you have versus credit. I think they like that about us. But I actually think it's one of our biggest assets.
Are there any other broad opportunity sets that you're excited about?
One of the things that we've been spending time on is an opportunity that's arisen because of the explosion in the pod shops and also the quant funds. This is not a new dynamic. These, the quant funds and these pod shops have gotten very, very big. They employ a lot of leverage, which of course allows them to invest even more assets. So we actually have recently found a derivative in an Asian market that we're buying for 10 to 20% of what we think it's worth. So 80 to 90% discount. And it's solely the result of the fact that there's a market in Asia that has such a large demand to be short because of these funds who go long short. So these indexes there's a massive demand to short them. And so we can construct derivatives on the other side of that. It just gives us asymmetric return. We put a little bit of capital to work, and we can earn multiples of our capital based on reasonable assumptions. And our downside is defined because we can only lose the premium that we put up. But the thing I love about it is that this didn't exist a year ago, 2 years ago, 3 years ago. But because of the explosion in the size of these funds, we were able to find it.
When you do have such disparate opportunity sets, how do you think about portfolio construction and position sizing?
When you think about the return characteristics of a Japanese stock versus a credit instrument versus a reinsurance contract, they are really different. And so we have developed this tool that we built internally that really is a variety of quantitative and qualitative factors that helps us think about the return characteristics across these different verticals and how we should think about sizing. Now, the quantitative factors that go into it will be things such as, what's your base case? What's your 90th percentile? What's the risk? If you get everything wrong, how much money do you lose? What's the timing? Is there a catalyst around it? Then we have a large number of qualitative things that we think about as well. So do we have a history of success doing this type of investment? Does it have a catalyst? We have a category for the Herb conviction score. So how strongly do I feel about this? How knowable? So the inputs, how knowable are the inputs? How knowable is the risk? Does the analyst have a history of success doing this? I think it's important to say that the model really is a starting point. It helps kind of stoke conversations. It helps, think, kind of based on all your history, what the model is telling you. And then it forms a great basis for a conversation. And then we go from there.
How do the conversations lead to an ultimate decision, either at a specific name or a bigger allocation in the portfolio?
We are a highly collaborative firm. We're all aligned with our partners. Nobody has their own P&Ls here. And so everyone is really aligned to find the best investments. And so what I have found, is the best way to run an investment process is, we'll have analysts who will go out, work on an investment. I tend to work on investments pretty closely with people. When they bring it to the group, we'll typically do that 2 or 3 times. We'll have large conversations around what we're looking at. I will be having conversations almost daily, if not weekly, with the individual analyst. And then ultimately, we only have one portfolio manager at the firm. So that's me. And so I have to give the go-ahead on an investment. So now where the model comes in that we just talked about is, so we will look at the model, look at how this investment stacks up versus other investments, what the model is recommending in terms of sizing, how I feel about that recommendation. Does it seem right based upon my experience? And then we'll go, based on that, and we'll execute on the investment. We have a large majority of our investments that go through this process that could take 6 months to a year from the time it gets into the portfolio. Sometimes you have a day to make a decision, right? And so those are the ones actually that are really fun, but just require a lot of focus. And so I think, the one that comes to mind, the recent one is Silicon Valley Bank, when that was really melting down. You had not a lot of information, and you're often trying to make decisions based upon this limited amount of information. Markets are incredibly volatile. Same thing happened with Credit Suisse, which was, of course, at exactly the same time. And so that, a lot of it for us is I'm really thinking about what's our downside? How much money could we lose? What's the return profile? And it goes back to what do we know and what don't we know? And so often I have found those types of fast moving investments tend to offer really attractive returns, but you have to process a lot of information very quickly. But there is some percentage of our investments that we do have to react, in a very short period of time. And I do think it's one of the advantages of our size. Like we can move fast. You're looking at the investment committee. So, off we go and we can make decisions. We can trade bonds over the weekend. We can move fast. And that ends up being a big advantage.
What are some of the biggest mistakes you've made over the last decade?
So I think one of the biggest mistakes was that, value investing has changed over the years. And so, I mentioned the old cigar butts, which turned to buying cheap stocks, doing stuff in emerging markets. And I think if I look at Finepoint, when we first started the firm, we were doing mostly things that I had had success with historically. But what happened was, if you think about buying cheap stocks and great businesses without a catalyst, like that doesn't work anymore. And so sometimes you have to, get punched in the gut a few times and have some bad experiences before you change. That ultimately ended up in, us focusing on more catalyzed opportunities as a result of that. So I would say the biggest changes, the biggest mistakes that I've made have been not adapting quick enough to what's happening in the financial markets. So somehow getting stuck on the past and thinking about, well, this always worked before, so it should work today. I'd done some successful stuff in the emerging markets. And then we ended up doing the same kind of investing, but the markets had changed and we have to change with it.
I'd love to ask you about the evolution of the business itself. What was the biggest challenge in getting the business where it is today?
So I think the thing I didn't fully recognize when I started Finepoint was how difficult it was going to be to start a firm and get it to a point where it was highly functioning. When I look back at Seth and Baupost and what a phenomenal culture and firm that he built, I think I took it for granted a little bit that it was going to be easy. And so, for us, we really want to have a firm with a culture that's very strong, including the highest ethical and moral standards, intellectual honesty, perfect alignment of our own interests with the interests of our LPs, always asking ourselves when we have difficult questions, what's in the best interest of our LPs? We want a culture of transparency. We want a culture of kindness, like a culture of respect. I firmly believe that everyone in this firm deserves a high level of respect, whether you're the man at the end of the day who's cleaning the office or you're the president of the firm. Everyone deserves a very, very high level of respect. And so getting all those ingredients right and hiring all the right people and getting everyone in the right seat and developing them and getting them to a point where you felt great coming into work every day was just a lot harder than what I thought it was going to be. So I have to say, to have come from Baupost and to see what Seth had built and to see how difficult that was, this gives me a lot more respect for him and for that firm. And today, when I walk into the firm, I can't tell you how good I feel, how happy I am when you see the fruits of that labor. And, there's an old saying about when you appreciate something a lot more when it's difficult, right? And that it took us a while to get to that place, but now I feel like we're at that place.
When you started, value investing wasn't so out of favor, and you really did start with quite a significant launch. How do you look at it today?
I'm very fortunate that I have a phenomenal set of LPs. I have a great team. I have people who are highly energized, who like coming to work every day. And we're really doing different things. And so, the firm today is size-wise is a little bit bigger than what it was, when we first started. But the types of things that we're doing are dramatically different. And so because of that, we hire generalists, we hire really good athletes, really smart people who are intellectually curious and can learn almost anything. And we plop them into our model as we go off and embark in looking at a whole variety of asset classes. And so I would say, we have a small number of LPs. We have a small team. We run a concentrated portfolio. We're a research-oriented organization. We're value investors. And so a lot of the fundamentals of who we are really haven't changed. What has changed is just the construct of the portfolio. We started out doing a lot of credit, maybe some equities. And if I look at what we're doing today, I mean, we're concentrated in Japan and reinsurance and a couple other things. I'd say our hedging program really has never changed. That's been probably the one part of our firm, the investment part, that has remained constant. I talked to you about how the investing style has changed, like, the focus on catalyst. We used to hold a lot of cash early on. As the team matured, as I matured, as we started doing things in different markets, we've been fully invested for a while now. And so that definitely changed. But also, I think the biggest change has just been the markets that we're operating in. We found great investments in places that I would have never thought. And, I'm extremely excited about what we're doing.
As you look out over the next 5 years, what do you hope Finepoint becomes?
So I'm actually really excited for the next 5 years for a number of reasons. So the first one would be we have a great team here. We just passed our 11th year anniversary. So, we still feel like we're relatively new, but I think over this first 11 years, we have built a plus team. So, and when you start from scratch, that doesn't happen overnight. It really doesn't. And we had some, and we've developed folks, we've invested in people. And so we have a great team. We spend a lot of time together. We work a lot. And we spend a lot of time outside the office together. Like, I'm fortunate enough, we have lunch together every day. It's like the best half an hour of my day is having lunch with my team. And so the second thing is, I'd say the things that we're doing, I'm really excited about. We're a concentrated portfolio. Most of them are catalyzed. Going back to what we talked about with reinsurance, reinsurance not correlated to the market. We really like that. Japan, of course, is. We have phenomenal LPs who would believe in us, who have given us a lot of rope to go out and find great investments. So I think I'm actually really excited about what we own. I'm excited about the areas that we're operating in. I'm excited about the team. And so that feels really good.
I want to ask you a couple of closing questions. Before I get to that, there's two things I want to ask you about outside of Finepoint. I used to joke that there was a time when people would be worried that if a hedge fund manager went out and made too much money, they would get distracted and, go buy a sports team or something like that. And it turned out that you owned a piece of a sports team before you even launched Finepoint. So people didn't have to worry about that with you. But would love to hear about your interest in baseball.
So part of it goes back to my paperboy days. So I grew up in the 70s in Dayton, close to Dayton, Ohio. So we were very close to the Cincinnati Reds. So as a kid, I was a huge baseball fan. So I still remember waking up and I'd get my 40 newspapers to deliver and I'd go straight to the box scores. Remember, you'd open up the newspaper and I'd spend a ton of time just going through every box score, memorizing the statistics for everybody. It just was a lot of fun. So even from a very young age, I was a huge Cincinnati Reds fan. And so, so back in 2012, through one of my mentors, I was offered the chance to buy a small piece in the Boston Red Sox. And I instantly jumped at it. I remember talking to my wife and I said, I'm not sure if this is going to be a good investment or not. In fact, it might go to zero, but I want to learn more about the sport. I want to learn more about the team. I want to have a deeper connection to what they're doing. And so she was supportive of that. And, over time, they bought a football team in the UK called Liverpool. They bought the Pittsburgh Penguins. They made a big investment in the PGA Tour. I tell people it's one of the best things I've ever done. It's so much fun. I've enjoyed it with my kids. I've enjoyed it with my wife. I sit in rooms and I listen to the GM for the Red Sox talk about what he's going to do. I pinch myself. I cannot believe I'm in the same room having these conversations. And so it's been an absolute joy.
And the other is your foundation. You've done a bunch of philanthropic work and would love to hear more about what you're doing there.
My wife and I both grew up in the Midwest. I think we have similar values. And we really believe in giving back. We really believe that we've been very fortunate in our lives, but there's a lot of need and there's ways that we can impact people in a very positive way. So we set up a foundation about 20 years ago. Our foundation is not going to be multi-generational. We're going to give all the money away during our lifetime. We really feel like societal problems are compounding a lot faster than I can compound capital. So there's a bigger need today than what there is even in 10 years from now. So let's commit ourselves to being thoughtful about it and actually executing it. So my wife actually runs our foundation. We work together on thinking about the different verticals and how we can make an impact. We focus primarily in global health and also employment opportunities for inner city youth, and then also in the arts. And so we have three verticals that we have really tried to specialize in and try to focus on. And we're gonna run like crazy to try to make the biggest impact that we can make between now and the time we can't do it anymore.
What's been most surprising about your philanthropic work?
I think the most surprising part is actually it's really hard to give away money. As dumb as that sounds, you feel such a responsibility. There's so much need and you feel such a responsibility to make an impact and help people. And like, you just don't want to make a bad decision. And, often you can't measure impact. Like an investment, you can measure whether it went well or not. If you give money to an organization that's providing healthcare to a certain part of the world or a certain neighborhood, it's really hard to measure success. And so there's not great financial metrics in a lot of what we do. So, interesting enough, it goes back to one of the questions that you asked, which is like, one of the things that we do is we find great people who have built organizations, great leaders, and we really invest in them. So I could give you a lot of examples of people that are making tremendous impact in these verticals. And a lot of it is you're trusting them to make good decisions. But I've been very surprised about it. It's tough. It's really tough to do a good job in that area.
Who's your favorite leader in the world of the charities you've given money to?
So I would say, hands down, my favorite leader would be someone named Paul Farmer. He ran an organization called Partners in Health. He passed away probably 3 years ago. But there's a great book written about him called Mountains Beyond Mountains by Tracy Kidder. And, Paul was somebody who was totally committed to helping people and providing the most vulnerable people with the best healthcare that he could. And he was such an inspiring individual, and he was so committed. And he built this phenomenal organization, and he's impacted millions of people in all types of different communities. And he's just been an inspiration to me. To know people like that is like, you just feel fortunate to have interacted with somebody with that mission and those kind of values, and somebody who dedicates their entire life to helping people. So luckily we meet a lot of those people. It's one of the coolest parts of the work that we do. My wife has a phenomenal team that she works with who help her on this mission. And so we've been very fortunate to have them along with us, really helping, to make an impact.
Herb, I want to make sure I get a chance to ask you a couple of closing questions. What is your favorite hobby or activity outside of work and family?
So I'd say two things. So first of all, I love to read. I think ever since college, as I really got into my academic studies, I've just really become a voracious reader. I read everything I get my hands on. I read fiction, I read nonfiction, I read investing books, I read sci-fi. I really believe it's relaxing for me, but it also just opens up different perspectives. You learn so much. Like I've gone through different phases recently, like reading about the Civil War, or I've been reading about old shipwrecks recently. So I just love to read. And I think the second one would be I love to exercise. So I've been biking to work for over 20 years. And so every day, some of the best parts of my day in the morning, my 30-minute ride in, and then the 30-minute ride home, nothing, just your thoughts on a bicycle. And so people have often asked me if that's dangerous, but there's a bike path right down the Charles River that I ride for the most part. And so, but if I'm not biking, I love to run. I still run half marathons and 10Ks, and I also like to swim as well. So I feel like I have a lot of energy. And so I love to expend it either on a bicycle or running.
What brings you the greatest joy?
So at this point in my career, the greatest joy is really mentoring people and then watching them grow, develop, and make a big impact. Like, being part of that and investing in people, helping in people. And we've had a number of people here at the firm who have made tremendous impacts for us and on the business, on the investment effort. And you spend time with people, you get to know people, and you invest in them, you give them advice. But ultimately, when they actually grow and they make a great investment and they're so happy with themselves and they're so proud and it impacts the organization in such a fun way, like that is really the icing on the cake. So, And, it goes back to what we were talking about with the team. Like, we have a great team here. I mean, a lot of them are so talented, they probably would have done great without me. But it's just, there's something that's really fun about seeing that and feeling like you play a small part in it.
I heard one more. If the next 5 years are a chapter in your life, what's that chapter about?
I'm actually really excited about the next 5 years. We have a phenomenal team here at Finepoint. The combination of great clients, great investment mandate, great portfolio. I'm excited about what could happen on the credit front. So I think professionally, the next 5 years could be the best 5 years of my life. The other thing that I'm excited about is, I've hit this stage in my life where my kids are launched. So I have 3 kids, and my youngest is going to be a senior in college here, but they're adults. Like, they're building their own careers. They're building their own lives. They have relationships. And so to help them navigate that, but to also to see where they end up and how they grow, and eventually to see their families grow, is something that I just think is going to be really cool. So I'm excited about that also.
Herb, thanks for this rare chance to share your story.